Imagine waking up tomorrow at 55 years old, opening your investment account, and realizing the strategy that made millions of younger investors rich no longer fits your life. One market crash, one medical emergency, one unexpected retirement. Suddenly, every risky decision carries a price you can no longer afford. But if Warren Buffett were over 45 and starting today, will he still invest the same way everyone on social media tells you to? The answer surprises almost everyone. And it begins with a lesson most investors learn only after losing a fortune. Picture Omaha, Nebraska. No glamorous skyline, no billionaire lifestyle. Just a young boy sitting with numbers, newspapers, and an obsession that nobody around him fully understood. Warren Buffett wasn't chasing excitement. He wasn't looking for the next hot stock or trying to become famous overnight. While others dreamed about fast money, he quietly learned something far more valuable. He discovered that wealth isn't built by predicting tomorrow. It's built by surviving tomorrow. That tiny difference changed his entire life. But the real power of that lesson wouldn't become clear until decades later. As Buffett grew older, markets changed, technology changed, and entire industries disappeared. Companies that once looked unstoppable slowly faded away. Investors kept falling in love with excitement, while Buffett kept falling in love with businesses that could still be standing 20 years later. People laughed at his patience. They called him old-fashioned. They believed the world had changed too much for his methods to work. Yet, year after year, the numbers kept proving them wrong. But hidden beneath those incredible returns was a rule that becomes even more important after the age of 45. Think about your 20s. You have time to recover from mistakes. Lose money today and you may have decades to earn it back. But once you cross 45, something invisible begins to change. Time quietly becomes your most valuable asset. Every bad investment steals not only money but years you can never replace. That changes the entire game. Yet, millions of people continue investing exactly like they did when they were 25. And that's where the danger begins. Imagine two investors. Both have $1 million. One is 28 years old, the other is 52. A market crash wipes out half their wealth. The younger investor still has decades to rebuild. The older investor suddenly faces retirement with half the savings. Same crash, same loss, completely different consequences. Buffett has always understood that successful investing isn't only about making money, it's about protecting the ability to stay in the game. But almost nobody talks about what that means after 45. Social media loves stories about people turning $10,000 into 1 million. They celebrate risk. They celebrate gambling disguised as investing. Every week, someone claims they found the next company that will multiply 10 times. Fear of missing out spreads faster than facts. Suddenly, sensible investors begin questioning themselves. They wonder if they're being too cautious. They feel pressure to chase what everyone else is buying. But Buffett has spent his entire career doing something almost nobody has the discipline to do. He waits. That sounds simple until you realize how painful waiting really is. Watching everyone around you brag about massive gains while your portfolio moves slowly can feel unbearable. Greed whispers that you're falling behind. Fear tells you that this opportunity will never return. Confidence starts turning into doubt. This emotional battle destroys more investors than any recession ever could. But what happened next changed the way Buffett thought about wealth forever. If Buffett were over 45 and building a portfolio for the next 10 years, He wouldn't start by asking which stock could double first. He would ask a much harder question: which businesses will still be making money no matter what headlines dominate tomorrow? Which companies sell products people cannot easily stop buying? Which management teams have already survived recessions, inflation, political chaos, and financial panic? Those questions sound boring. That's exactly why they work. Think about companies that quietly operate while the world argues online: insurance, consumer goods, railroads, energy infrastructure, payment networks, healthcare. People still eat during recessions. They still brush their teeth. They still insure their homes. They still use electricity. Buffett has always preferred businesses connected to everyday human behavior instead of temporary excitement. But nobody could have predicted how important that mindset would become in an age dominated by hype. Every generation believes it's living through a completely new financial revolution. The internet changed everything, then smartphones changed everything, then artificial intelligence promised to change everything again. Some of those revolutions created enormous wealth, others destroyed fortunes overnight. Buffett never ignored innovation, but he refused to invest simply because everyone else was excited. He understood something psychology researchers continue proving today. Crowds often become most confident exactly when risk is highest. Now imagine you're 48. You have children approaching college, aging parents may soon need support. Retirement no longer feels like a distant dream. Suddenly, your investments aren't just numbers on a screen. They represent future vacations, healthcare, family security, and peace of mind. One reckless decision could affect people you love. That's why Buffett would probably become even more selective instead of more aggressive. But here's the twist almost nobody expects: being conservative doesn't mean avoiding growth. Many people confuse safety with doing nothing. Buffett never believed that. He believed in intelligent risk. If he found an extraordinary business selling below its true value, he would invest heavily, but only after understanding exactly how that company made money. If he couldn't explain the business in simple words, he usually walked away. Imagine how many disasters could have been avoided if more investors followed that single rule. Then comes cash. Most people think cash is wasted potential. Inflation slowly reduces its value. Financial influencers constantly warn against holding too much. Yet Buffett has repeatedly kept enormous amounts of cash when opportunities looked overpriced. Why? Because cash isn't only an investment, it's freedom, it's optionality, it's the ability to buy when everyone else is forced to sell. During panic, cash transforms from something boring into something incredibly powerful. But the real lesson is even deeper. Imagine a financial crisis arrives tomorrow. Markets collapse. Television anchors predict disaster. Friends call you in panic. Social media fills with fear. Investors rush to sell at almost any price. Those carrying too much debt become desperate. Those with no cash have no choices. But someone sitting on liquidity suddenly sees opportunities everywhere. Buffett has often compared investing to waiting for the perfect pitch. You don't have to swing at every ball. That patience becomes priceless after 45. Debt creates another invisible trap. When you're younger, borrowing may feel manageable because time seems endless. But later in life, debt steals flexibility. A large mortgage, expensive lifestyle, car loans, and high interest credit cards quietly reduce your ability to invest during market downturns. Buffett has never been a fan of unnecessary leverage. He understood that surviving difficult years matters more than looking successful during easy ones. What happened next shocked countless investors during every major crash. the strongest portfolios weren't always owned by the smartest people. They were often owned by the people who simply refused to panic. Look back at every major market crisis: the dot-com crash, the financial crisis, the pandemic panic. Each time, fear convinced investors that everything was different forever. Each time, quality businesses eventually recovered while emotional decisions permanently damaged countless portfolios. Buffett repeatedly reminded investors to be fearful when others are greedy and greedy when others are fearful. Simple words, almost impossible to follow when billions of dollars disappear in front of your eyes. Now imagine Buffett sitting across from someone who has just turned 50. The investor asks, "Should I chase the newest technology stock?" Buffett smiles. Instead of answering directly, he asks another question. If the stock market closed for 10 years, would you still be happy owning this business? Silence fills the room. That single question eliminates countless speculative investments instantly. Because when you stop thinking like a trader and start thinking like an owner, everything changes. But the hardest shift isn't financial, it's psychological. Many people over 45 feel pressure because they believe they're behind. They compare themselves with entrepreneurs who became billionaires before 30. They watch influencers showing luxury cars and expensive vacations. Regret becomes dangerous. Desperation follows. Desperation creates terrible investment decisions. Buffett has always warned against emotional investing because emotions rarely understand probabilities. They only understand urgency. Then there's diversification. Some investors believe owning 50 different stocks automatically makes them safe. Buffett has often argued the opposite. Diversification protects people who don't know what they're doing, but concentration without knowledge becomes gambling. If he were investing after 45, he would likely build a focused portfolio of businesses he deeply understood rather than endlessly chasing every trend appearing on financial news. But another challenge quietly appears with age: health. Nobody likes talking about it. Yet medical emergencies can destroy financial plans faster than recessions. Buffett understands that wealth isn't valuable if every dollar remains trapped inside investments during emergencies. Maintaining liquidity, planning expenses, and protecting family members become just as important as maximizing returns. This single decision changes everything because investing stops being about becoming rich and starts becoming about staying secure. Now picture a roaring bull market. Everyone feels like a genius. Stocks climb every week. Friends recommend companies they've barely researched. Financial television celebrates new records daily. Greed spreads like wildfire. This is often when Buffett becomes most cautious. Not because he fears success, but because high prices reduce future returns. Buying wonderful businesses at terrible prices eventually becomes a terrible investment. That lesson has cost investors billions over the years. Then the opposite happens. Markets collapse, headlines scream panic. Experts predict the end of capitalism once again. Ordinary investors freeze. But Buffett begins paying closer attention. Why? Because fear often creates discounts impossible to find during optimistic times. The same business everyone loved 6 months earlier suddenly becomes unwanted. Human psychology changes much faster than business fundamentals. That's where disciplined investors quietly separate themselves from emotional crowds. If Buffett were planning only the next 10 years after age 45, he probably wouldn't obsess over becoming the richest person in the room. He would optimize for something far more meaningful: peace of mind. Imagine sleeping well regardless of tomorrow's headlines. Imagine knowing your investments are backed by businesses producing real cash flow instead of empty promises. Imagine not checking stock prices every 15 minutes because your confidence comes from understanding, not hope. That's a different kind of wealth, and it's surprisingly rare. One mistake continues destroying experienced investors. They mistake activity for progress, buying, selling, switching strategies every month, chasing predictions, reacting to every economic report. Buffett built one of history's greatest fortunes by often doing less than everyone else. His inactivity looked boring, his results looked extraordinary. Patience became his competitive advantage because almost nobody else could tolerate it. But perhaps the biggest lesson has nothing to do with stocks, it's about character. Markets constantly test human behavior. They reward discipline, they punish arrogance, they expose greed, fear, impatience, and overconfidence. Every market cycle becomes a mirror reflecting who investors truly are. Buffett spent decades mastering himself before mastering markets. That's why his philosophy survived generation after generation. Imagine reaching 65, looking back. You won't remember every quarterly earnings report. You won't remember every financial headline. You'll remember whether your decisions created freedom or stress, whether your family felt secure, whether your wealth became a tool instead of a source of anxiety. That's the investment Buffett has quietly been making all along. If he were over 45 and starting today, he probably wouldn't chase every revolutionary company, every cryptocurrency rally, every viral stock recommendation, or every promise of overnight riches. He would buy outstanding businesses with durable advantages, keep meaningful cash ready for opportunity, avoid unnecessary debt, ignore the noise, remain patient during euphoria, stay courageous during panic, and allow compounding to perform the heavy lifting. Because the greatest secret isn't finding the perfect investment, it's becoming the kind of investor who can survive long enough for great investments to work. Fortunes are rarely destroyed by one bad stock. They're usually destroyed by fear during crashes, greed during bubbles, and impatience in between. The next 10 years will almost certainly bring another boom, another crisis, another wave of excitement, another wave of panic. Nobody knows exactly when, nobody knows exactly why, but history suggests they will come. And when they do, the people who win won't necessarily be the smartest, the fastest, or the luckiest. They'll be the ones who prepared before everyone else realized preparation mattered. Because after 45, investing is no longer about proving how much risk you can take. It's about building a future so strong that no single crisis can take it away. That quiet mindset, more than any stock pick or market prediction, is the closest thing Warren Buffett has ever offered to a blueprint for lasting wealth.